All right, hello everybody. So we're about to listen to the Credit Suisse earnings call. Credit Suisse last year during 2021 did not have a good year. If you remember early on in, I believe it was March of 2021, the hedge fund slash family office Archegos collapsed. Credit Suisse had been a major lender to Archegos, and while Archegos's equity previously had been about $10 billion, Credit Suisse had exposure to over $5 billion. So when the fund collapsed, they lost about $5.5 billion. Later in the year, they lost another 1.1 billion to litigation. They also had an investment that they had made in a previous decade go bad, and so took a huge hit on that as well. In addition, they had a major scandal come forward where it came to light that there was potentially hundreds of millions of dollars worth of transactions going through Credit Suisse related to money laundering. Then, to top all of that off, in January of 2022, their chairman resigned over issues with COVID rules. And that chairman had come in to try to turn the company around from problems that had been, even before 2021. So it's been a serious series of unfortunate events for Credit Suisse. If you look at their chart over 5 years, right, you can see the stock has just been hit again. Um, Despite all of that, Credit Suisse is still a major global institution in finance. So 2022 will be an interesting year. While the company has had a lot of problems, I think that gives an interesting opportunity to investors potentially, right? I don't think Credit Suisse is a necessarily a good investment right now, but I think it's worth watching because the company is in the middle of trying to deal with all of these scandals, all of these previous, hits on their balance sheet. They're trying to restructure the company to draw new strategies. And that's the kind of thing that throws a lot of investors off. A lot of pensions and big institutions will not want to invest in Credit Suisse while it's engaging in that kind of activity, which means that their stock price may drop to interesting levels. And then if the company succeeds in sort of restructuring and it looks like it's going to come out okay, that's when I think it would be an interesting time to potentially invest. Again, I don't think it's a good investment right now, but I think it's worth watching. And as they restructure, as they develop a new strategy going forward, they have a huge existing, set of relationships with companies around the world. So if they can harness that, if they can manage to turn themselves around, there could be some money to be made there. So let's go ahead and start listening to their earnings call. Give me 1 second.
Before we begin, let me remind you of the important cautionary statements on slides 2 and 3, including in relation to the forward-looking statements, non-GAAP financial measures, and Basel III disclosures. For a detailed discussion of our results, we refer you to the Credit Suisse first quarter 2022 earnings release published this morning. Let me remind you that our first quarter 2022 financial report and the accompanying financial statements for the period will be published on or around May the 5th. I will now hand over to our Group CEO, Thomas Gottstein, and our Group CFO, David Mathers, who will run you through the numbers.
Thank you, Kinner, and thank you all for joining our first quarter 2022 results presentation. We greatly appreciate your participation and engagement. Let me begin by addressing the broader economic and geopolitical environment. Financial markets enter 2022 dealing with some of the highest inflation rates in a generation, putting significant pressure on central banks and weighing on the purchasing power of many of our fellow citizens. In addition, Russia's invasion of Ukraine has led to a catastrophic humanitarian crisis. Credit Suisse and its employees would like to express our sympathy and support towards the Ukrainian people as we continue to show our solidarity through support for aid groups and other organizations. The Ukrainian crisis has also had a significant impact on the global economy, financial markets, and many businesses, including our own, during the first quarter, as you will have seen in the reports from many of our global peers. As I've said previously, In the context of our long-term strategic plan, the year 2022 is one of transition for us at Credit Suisse. We are determined to continue with the implementation of our strategy as announced in November last year and remain focused on refining and reinvigorating our franchise consistent with our approved risk appetite. The financial performance in the first quarter of 2022 highlights our work in progress and what more we need to do. As we disclosed last week, we reported a loss in the first quarter. This was partly a consequence of our decision to increase provisions relating to developments in a number of previously disclosed legacy legal matters. This is in line with our proactive approach to resolving legacy litigation matters, many of which go back more than 1 decade. Our results were also negatively impacted by Russia-related losses of 206 million Swiss francs. As you will see in the slides, we have already made significant concrete progress in executing our strategy across our divisions with a simplified structure that went live on January 1st. Before I turn to the presentation, as you have seen today, we have announced a series of appointments to the Executive Board as well as management changes. We are delighted to welcome Francesca McDonagh as incoming CEO of the EMEA region, Edwin Lowe as CEO of the Asia Pacific region, and Markus Diethelm as General Counsel. They will take up their roles in the coming weeks and months. David, who has served as Chief Financial Officer since 2010, has indicated his wish to seek alternative opportunities outside of Credit Suisse. While I have accepted his request with regret, I look forward to working with him over the coming months until a successor is found. And on a personal note, I would like to add that I will not only miss him as a competent CFO, but as a friend and colleague. But we still have several months to go. David.
Thank you very much.
I would also like to thank Romeo and Helman for their service to the bank over the many years, and I'm very pleased that Helman will serve as senior advisor to me, focusing on core clients around the APAC region, as well as serving on our Asia Advisory Council. The determined delivery of our strategy over the coming quarters is the absolute focus of the Board of Directors, the Executive Board, and all our employees. With that, let me turn to the slides, starting with our key messages from the first quarter on slide 4. We recorded a 0.4 billion Swiss franc pre-tax loss in the first quarter, as our reported results were negatively impacted by 0.7 billion Swiss franc of legal provisions, by 0.2 billion Swiss francs Russia-related losses, and by 0.4 billion Swiss franc market value losses related to our Allfunds stake. These were offset somewhat by real estate gains and a net release of provision for credit losses. On an adjusted basis, we reported pre-tax income of 0.3 billion Swiss francs. Overall, we saw net revenues decline year-on-year, mainly due to a particularly strong comparable in the first quarter of 2021, especially in the investment bank and wealth management. We also experienced significant industry-wide headwinds in the form of more challenging market conditions due to higher inflation and interest rates, as well as Russia's invasion of Ukraine impacting a number of our businesses. In the first quarter, we reduced our Russia-related net credit exposure by 56%, and we continue to make further progress in exposure reductions. David will discuss this in greater detail later. We have continued to run our businesses with a strong capital base. Our CET1 ratio was 13.8% in the first quarter of 2022, compared to 12.2% the same period 1 year earlier. Our CET1 leverage ratio was 4.3%, also up from prior year levels. We stand by our medium-term guidance of a CET1 ratio of at least 14% pre-Basel III reforms and a CET1 leverage ratio of around 4.5%. While our performance has been impacted by significant headwinds, our focus remains on executing the strategy we set out in November 2021. I will go into details a bit later, but as you can see from the middle of the slide, we have made considerable progress on key aspects of our integrated strategy. Regarding risk, the strengthening of both our first and second lines of defense are on track. We are confident that our strengthened risk culture should help us build a stronger and customer-centric bank that puts risk management at the core to deliver sustainable growth and value for investors, clients, and colleagues. Next slide, please. Here you see some of the factors affecting our reported and adjusted results in the quarter. Our adjusted results were characterized by recent client activity and capital markets issuance in volatile market conditions. They also, by reduced client activity and capital markets issuance, They also reflect the cumulative reduction in risk appetite in 2021, the impact of the flattening yield curve on corporate center treasury results, and increased cash accruals for compensation due to the normalized deferral level. Let me turn now to the divisional breakdown. Next slide, please. In terms of adjusted pre-tax income and net revenues, Wealth Management had a challenging start to the year, with adjusted PTI adversely impacted by lower transaction activity and further reduced lending volumes. The results were also impacted by Russia-related effects and APAC Financing Group mark-to-market losses, which combined were approximately 130 million Swiss francs. Still, we increased investments, including in talent, and saw positive net new assets across regions, reflecting our client franchise strength. Our investment bank results were impacted by our continued efforts toward our planned exit from prime services, the slowdown in capital markets, as well as the Russia-related impact on our GTS results. It is important to remember that our franchise mix, which particularly benefited us in the first quarter of 2021, was less supportive in the recent environment, given our much more limited exposure to macro and commodities sectors that performed particularly well in the first quarter. Despite this effect, the IB posted solid performances across equity derivatives, securitized products, and M&A. The advisory pipeline was up quarter-on-quarter as well as year-on-year. Our Swiss bank had a good performance with stable net revenues from higher recurring commissions and fees and strong net new assets from the institutional client business. Asset management had lower pre-tax income and softer revenues due to the market environment and reduced activity levels. However, recurring management fees were broadly stable with higher investment and partnership income. Next slide, please. We made a number of decisive actions throughout 2021 to strengthen risk and compliance teams, systems, and processes. As you know, we underwent a comprehensive risk review across the entire group, which was completed in the fourth quarter. Our de-risking measures have improved our risk profile, but also have negatively impacted our top line in the short term. For example, the de-risking measures in wealth management that you see on the left of the slide led to a reduction of roughly 25 million Swiss francs in net revenues during the first quarter. In the investment bank, the de-risking led to approximately 250 million Swiss francs in reduced revenues. Notwithstanding the expected impact from our planned exit from the remaining part of Prime, our growth ambitions are fully aligned with our risk appetite. Strengthening risk management and addressing legacy issues remain a focus even as we implement our growth strategy. Here you see selected updates of our progress on risk and compliance topics and our proactive approach to resolving litigation cases, whether by settlement or dismissal, which you can see on the right side of this page. Next slide, please. We are focused on refining and reinvigorating our franchise in order to drive forward our vision for Credit Suisse. We are convinced it is the right strategy even in the midst of volatile markets and economic conditions which are challenging. Please allow me to give you just a few examples of our determined execution of this strategy. We have achieved $2.5 billion reduction in allocated capital in the investment bank since the fourth quarter of 2020, which amounts to over 80% of our more than $3 billion ambition. We launched an outsourcing agreement on April 1, 2022 to generate procurement savings and aim to step up synergies from unified operating platforms and technology platforms and the divisions in the coming quarters. This should help us meet our ambition of 1 to 1.5 billion Swiss francs in structural cost savings per annum by 2024 to invest in our growth ambitions. In wealth management and private banking Switzerland, we achieved mandate penetration of approximately 33% in the first quarter, near our 33 to 35% ambition. In the investment bank, we reached an 84% reduction in prime balances since the first quarter of 2021, with our goal of a full prime services exit by the end of 2022 at the latest, which should allow us to generate significant cost savings. We added approximately 50 managing directors in the investment bank, underscoring our commitment to attract talent. In our Swiss bank, we reached 125,000 clients for our digital offering CSX as of the first quarter 2022, with an ambition to reach 200,000 by year-end. Let me discuss each division in more detail. Starting with wealth management on page 10. We aim to progressively deploy resources in wealth management under the new divisional leadership of Francesco De Ferrari to accelerate growth. We have made meaningful progress in laying the foundations for integrated wealth management and defined and initiated 10 execution priorities that reflect the changing geopolitical climate. These include client segments, priority markets, products and solutions, simplification and people. We have also started execution on our initiative roadmap. Examples include the exit of private banking activities in sub-Sahara Africa markets, excluding South Africa, and accelerated digital outreach in the core high net worth individual segment. We invested in 50 relationship managers net, mainly in Asia Pacific, Switzerland and EMEA. I would also point out that higher US dollar interest rates should provide benefits to the bank through incremental net interest income of an estimated 550 million Swiss franc through 2023, which David will address later. As with each of our divisional slides, you can see our key medium-term ambitions at the bottom of the page, which remain unchanged. Let me turn to the investment bank. Christian Meissner and his team have made continued progress reshaping the investment bank, and on this page you see some of our specific actions. We have released capital from Prime and de-risked the franchise. We have increased connectivity to wealth management in GTS to build a global franchise. We are investing in the capital-light investment banking and capital markets business. In the first quarter, we grew market share in both EMEA and APAC, with top 5 market positions in both. We are driving growth in our market-leading credit and securitized products businesses. Slide 12. André Helfenstein's Swiss business has been a resounding success and is an anchor for our transformative agenda. The division continues to focus on growing our market-leading mid- and upmarket franchises in private, corporate and institutional banking. We have seen strong growth in our digital offering, notably CSX, and we are simplifying and digitalizing front-to-back processes. We are well positioned to capitalize on the post-COVID normalization in credit cards, FX and in leasing. Next page, please. Under the leadership of Uli Körner, we have also made solid progress executing our ambitious strategy in asset management with a focus on talent and technology. We have strengthened and simplified the organization with a number of key leadership hires. We joined the Net Zero Asset Managers Initiative, underscoring the manner in which our group-wide sustainability strategy is embedded across divisions, including asset management. And we have strengthened risk management and our control environment. Next slide, please. Our investments in technology are a significant focus of our ambition to simplify our business model, drive digitalization, and maximize our client experience. We have started implementing the engineering strategy in our recently established Chief Technology and Operations Organization under the leadership of Joanne Hannaford. We recently announced the CTOO organization and leadership team and are focusing on agility, digital transformation, and productivity across our 3 group strategic pillars. Many of the underlying efforts have started and are progressing well. Next slide, please. Credit Suisse continues to emphasize the importance of sustainability as a core element to our value proposition for our clients, shareholders, employees, and society as a whole. We made significant progress executing our 5-pillar strategy in 2021, and many of our objectives and achievements are outlined in our 2021 sustainability report. Let me outline some of our achievements here. We reached sustainable assets under management of 144 billion Swiss francs at the end of the first quarter, up from 118 billion Swiss francs in the first quarter of 2021. We also increased sustainable AUM penetration as a share of total assets under management. We are proud to have earned the Sustainability Bond of the Year Sovereign Award for our role as sole structurer and arranger of the Blue Bond for the Nature Conservancy. And on the right side of this page, you see our progress and our way forward. Emma Crystal, our new Chief Sustainability Officer, is driving these efforts in close collaboration with all 4 businesses. We remain committed to supporting our clients' transition and expanding our sustainable investment and financing offering as we make further progress toward our ambition of providing at least 300 billion Swiss francs in sustainable financing by 2030. I would now like to hand over to David, who will go over our results in more detail.
Thank you very much, Thomas, and good morning to everybody. So I'd like to go through the key financials and provide some more details on our performance at the group and at the divisional level. Just to be clear, this is of course the first time that we're presenting these numbers under the new divisional structure, which took effect from the 1st of January 2022. Now, before I turn to the numbers, I'd just like to make a few introductory points. You'll recall that last week, on April the 20th, we issued a trading update which flagged an increase to our legal provisions of approximately 600 million Swiss francs in relation to the developments in a number of previously disclosed matters, all of which originated more than a decade ago. We also highlighted the negative impact of over 200 million Swiss francs relating to the effects of Russia's invasion of Ukraine. Now, in the adjusted numbers, we will, as usual, exclude all the major litigation provisions, but to be clear, we are not excluding the Russia-related impact in the adjusted definition. Now, second, I'd like to make a broader point on Russia's invasion of Ukraine. Now, whilst the tragic humanitarian aspects of this conflict remain, of course, front of mind, the disruption to financial markets, as well as the breadth and the depth of the sanctions introduced by the Swiss, UK, European and US authorities in response to this, have also been significant. In keeping with our peers, therefore, I will be providing further detail on the impact this has had within our different business lines in the first quarter. Third, I just note that as we continue to execute on the strategic plan, with the investment spending, internal reorganisation, and the capital reallocation associated with this, our risk appetite and our risk management remain key focuses. Now, this combines clearly with a period of reduced risk appetite and lower activity from our clients, the overall impact of which has been a decline in revenues across our major business lines. Now, as I'm sure you know, the first quarter of 21 was particularly strong in terms of our underlying performance, that is, excluding the Archegos charge, and the comparison to this quarter's figures should be seen in that context. Let me just start then with a summary of the group's results, and let me first remind you of the three significant items of the quarter that we highlighted in last week's statement. First, since the listing of Allfunds in April of last year, we have seen and continue to see mark-to-market volatility in the stock market price of this publicly listed entity, of which, as you know, we own about 8.6%. In the first quarter, we booked a loss of 353 million Swiss francs as a consequence of the fall in Allfunds' share price during the first quarter. As you'll note, we listed this risk in our 2021 annual report, which we published last month. I would remind you, though, that this has been and remains a successful transaction, and that Credit Suisse has, to the end of March 2022, booked a cumulative gain of 971 million Swiss francs, even including the loss in the first quarter. Second, we booked gains of 164 million Swiss francs in the quarter as we continue to optimize our real estate portfolio. And third, our provision for credit losses includes a release relating to Archegos of 155 million Swiss francs. You may remember that we recorded a similar net gain relating to the Archegos exposure of 235 million Swiss francs in the third quarter of last year, and we clearly continue to seek further recoveries from the estate. Now, going through the key reported figures then, our net revenues were 4.41 billion Swiss francs, 42% lower year on year, with declines across wealth management, the investment bank and asset management offset to a degree by the resilient performance in our Swiss bank. With regard to the provision for credit losses, we had a net release of 110 million Swiss francs, driven by the Archegos related release of 155 million Swiss francs that I've already mentioned, but offset clearly by new provisions of 58 million Swiss francs relating to Russia's invasion of Ukraine. However, the increases in litigation provisions that I've mentioned, which took the total to 703 million Swiss francs the quarter, contributed to a 26% increase in reported operating expenses, totaling 4.95 billion Swiss francs. That means we reported a pre-tax loss for the quarter of 428 million Swiss francs, compared to the reported pre-tax loss of 757 million Swiss francs in the first quarter of 2021. Now, on an adjusted basis, that is excluding Allfunds and the real estate gains, the Archegos release, major litigation provisions and certain other items, we delivered a pre-tax income of 300 million Swiss francs. If you were to exclude the Russia-related impact, that would have equated to an adjusted pre-tax income of 506 million Swiss francs. Now, just a brief point on operating expenses. One recurrent theme that you'll notice as we go through the materials is around the normalization of our compensation deferral levels and the consequent increase in cash accruals compared to last year. And I'll give some more details on this shortly. Before we get to that, let me give you some more details on the impact of Russia's invasion of Ukraine and what it has had on our first quarter performance. Now, you'll remember that we did give some disclosures on this with the publication of our annual report on March 10th, and we provided a further update since then. Now, just to summarize that, on March the 10th, we said that our 2021 credit risk exposure was 1.57 billion Swiss francs gross and 848 million Swiss francs net. We've reduced these figures significantly in the first quarter, with net credit exposure at the end of the first quarter standing at 373 million Swiss francs. That's about 56% lower than at the end of 2021. Now, if we consider the impact of these events on our P&L in the first quarter, there are three broad themes. First, we were generally successful in reducing our exposure before the invasion, but we did see some defaults on amounts owed to us by Russian counterparties, partly due to the impositions of the sanctions and certain other developments. Second, we took a limited amount of specific credit provisions across the bank. And third, our scenario review of the provision for credit losses led us to increase our non-specific provisions, that is related to CECL accounting, by 44 million Swiss francs. Overall, we saw a negative impact of 206 million Swiss francs on pre-tax income with respect to Russia's invasion of Ukraine in the first quarter, comprising 58 million Swiss francs in the provisions for credit losses and 148 million Swiss francs of trading and fair value losses. Just to be clear, that was split across the divisions as follows: 99 million Swiss francs in wealth management, $101 million in the investment bank, and 14 million Swiss francs in the Swiss bank. Now, more broadly, in terms of the wealth management's division's exposure to Russia, I think you'll recall that at the Morgan Stanley Financials Conference last month, Thomas confirmed that about 4% of our assets under management was linked to Russian clients globally. And just to be clear, that number's not changed significantly since then. In terms of our general position with respect to Russia, clearly we've stopped pursuing any new client business in Russia. We continue to reduce our exposure to Russia, as the figures that I've just given demonstrate. We're helping our clients to unwind their own exposure, and we have moved roles out of Russia. I would make it clear that we're making no new investments in our Russian subsidiaries and have not done so since the invasion on February the 24th. And I'd reiterate that as a matter of principle and policy, Credit Suisse applies international sanctions worldwide, in particular those issued by Switzerland, the European Union, the UK, and the United States. Let's turn to expenses now. So as I said at the end of the fourth quarter, and I just reiterate now, we're guiding for adjusted operating expenses for 2022 to be around 17 billion Swiss francs. The 9% increase that we see in the adjusted operating expenses compared to the first quarter of last year is primarily driven by two factors. First, the increased cash accruals for compensation due to the normalization deferral rates that I referred to earlier. As you remember, as part of our response to the Archegos and to the supply chain finance matters last year, we both reduced variable compensation overall and increased the amount deferred, thereby reducing the cash component and increasing the amount carried forward to future years. We do not believe this is sustainable over the long term, leading as it does to a build-up in future compensation liabilities. And so we've decided, as we highlighted at our fourth quarter results in February, that we're going to revert to a deferral table in line with that of our European peers for the current year. For the first quarter, all these changes have had the impact of increasing compensation costs by 214 million Swiss francs overall, and that's in line with the guidance that I gave that we should expect an increase in compensation costs for the year of about 1 billion Swiss francs. Now, just to be clear, I'd stress that at this early stage in the year, we're not forecasting a change in the economic value of the awards. This reflects the change in the deferral tables. Now, the second factor driving the year-on-year increases in expenses is incremental investments of 152 million Swiss francs in the quarter. These relate to our strategic priorities, particularly in respect to the wealth management businesses, together with the investments in risk and compliance remediation and the supporting work on IT systems to support our growth. I'd expect the bulk of the savings from these investments to flow through in 2023, particularly from major projects like the reunification of the IT platforms across the bank, which should yield significant savings, which I'll discuss in more detail at our planned investor deep dive, which I'll talk about towards the end of my presentation. I would add, though, that we are beginning to see initial cost measures savings from other measures, for example, through the outsourcing of our procurement function to Chain IQ. This arrangement went live at the start of April, and we're on track to achieve about 150 million Swiss francs of cash savings this year. Now, just to be clear, in addition to these incremental investments, we have taken restructuring expenses, which feature in the reported numbers, and that totals about 79 million Swiss francs over the past 2 quarters, of which 46 million Swiss francs was in the first quarter of 2022. I just repeat our guidance for restructuring expenses to total about 400 million Swiss francs, with the balance to be utilised over the rest of this year. Next slide, please. Now, what I show here is the quarter-on-quarter decline in client business volume across wealth management and private banking Switzerland, which is 5% lower at 1.24 trillion Swiss francs. This reduction is primarily driven by market moves in the period, partly offset by net new assets of 4.6 billion Swiss francs in the quarter, the majority of which were achieved in Switzerland and in Asia Pacific, notwithstanding the deleveraging environment that we see in that market. You'll note that we've allocated 16 billion Swiss francs of AUM to a line noted other. That includes about 10 billion Swiss francs of assets which have been reclassified due to the impact of the sanctions imposed in connection with Russia's invasion of Ukraine earlier this quarter. Let's now look at capital, please. Our capital and leverage ratios remain resilient. Our CET1 capital ratio was 60 basis points lower compared to the end of the fourth quarter at 13.8%. This drop below our ambition to be at 14% pre the start of the Basel III reforms in 24 was primarily due to internal model and parameter updates, with 2 billion of the 5 billion Swiss franc quarter-on-quarter increase in risk-weighted assets due to operational risk, excluding the related FX impact. I would note that we did see an RWA reduction of $2 billion due to the prime service exit in the investment bank, with the balance of the increase due to FX. Our CET1 leverage and our Tier 1 leverage ratios were both unchanged quarter-on-quarter at 4.3% and 6.1% respectively. Leverage exposure overall was down by 11 billion Swiss francs, and that includes a reduction of $20 billion due to the prime service exit. This was partly offset by a seasonal increase in business activity and by the weakening of the Swiss franc against the US dollar. I'd just like to touch briefly on the Swiss CET1 capital ratio for Credit Suisse AG, the parent company. You'll recall that in February, I mentioned that the ratio had fallen at the end of last year to 11.7%, and then with the phase in the transitional regime to 11.4% as of January the 1st, 2022. At the end of the first quarter, this ratio had increased to 11.8% due to the combination of a dividend payment from Credit Suisse and a capital repatriation from our US holding company, together totaling around 2 billion Swiss francs. We continue to execute on our other dividend and capital repatriation plans for 2022, although clearly, as we said before, these remain subject to regulatory approval, and I expect the bulk of them to arise in the second half of the year rather than in the second quarter. Just in terms of the group CET1, I just remind you that our medium-term ambition remains to operate at a CET1 ratio of at least 14% pre the Basel III reforms and a CET1 leverage ratio of around 4.5%. Let me turn briefly now and let's look at net interest income sensitivity. I did want to spend a few minutes on this, particularly given the level of interest rate moves that we've seen so far this year. If you look at the current exposure to rising US dollar rates, on the current forward curve, we'd expect about 150 million Swiss franc benefit in 22 compared to 21. And if you look at the current forward curve again into 2023, that should equate to a further 400 million Swiss franc benefit for next year compared to 22. Now you'd note, and I've said this before, at some point we would expect the European Central Bank and the Swiss National Bank to increase rates. Whilst we'd likely benefit overall from higher euro rates, you should remember that an increase in Swiss interest rates from the current level of minus 75 basis points would result in a drop in net interest income in the Swiss bank, at least in the initial phase. Now let me turn now to the overviews of the new business divisions, and we'll report this as usual on an adjusted basis unless I state otherwise. And let's start please with wealth management. Net revenues of 1.51 billion Swiss francs was 12% higher than the fourth quarter, but 22% lower compared to the strong first quarter of last year. We can see that whilst both net interest income and recurring commissions and fees declined broadly in line with a 9% fall in client business volume at 8% and 5% respectively, transaction-based revenues fell by 38%. That reflected a substantial decline in contributions from the GTS joint ventures of the investment bank, in line with the normalization of market conditions compared to the first quarter of 2021, as well as lower brokerage and product issuance fees. Of this 360 million Swiss franc decline in transaction-based revenues, you should note that 59 million Swiss francs was directly linked to Russia's invasion of Ukraine. You should also note that further weighing on the division's performance was mark-to-market losses of 32 million Swiss francs in APAC financing compared to last year. In terms of expenses, these were 16% higher year-on-year at 1.27 billion Swiss francs, the bulk of which was due to increased cash accruals relating to the normalization of compensation deferral levels that I've already mentioned. But we also made further investments in technology, in risk and in compliance, as well as executing the increase in our relationship manager headcount. Now, provision for credit losses of 24 million Swiss francs included 40 million Swiss francs of primarily non-specific provisions for expected credit losses relating to Russia's invasion of Ukraine, meaning the total impact of the invasion to the division's pre-tax income was 99 million Swiss francs in the first quarter. Overall pre-tax income was 74% lower year-on-year at 212 million Swiss francs. But we did, though, see net new assets of 4.8 billion Swiss francs, 4.8 billion Swiss francs booked in the period. And that's a reversal, clearly, of the net asset outflows that we saw in the previous quarter. Just let me turn now to the investment bank. Now, as has been the case with our peers, investment bank revenues were significantly lower compared to the record first quarter of last year. Though they were 11% higher than the previous quarter, that is the fourth quarter of 21, at $2.02 billion US dollars, that still equates to a 53% reduction year on year. This reflects three factors. First, our decision to exit prime services, which directly resulted in a year-on-year decline in revenues of 173 million US dollars. Second, our reductions in risk appetite and in allocated capital, which contributed to lower revenues, especially in leveraged finance. And third, the market disruptions caused by Russia's invasions of Ukraine, which contributed to significantly lower ECM market activity and reduced M&A fees. Overall, Russia-related losses totaled 101 million US dollars in division, primarily due to trading and fair value losses in the GTS business. That said, our equity derivatives business, while not seeing the strength of trading in the first quarter of last year, still performed well in the first 3 months of 2022. And our fixed income results reflected normalized securitized products revenues, lower than in recent periods, but still above historic levels. Operating expenses were 6% higher year on year at 2.08 billion US dollars, largely due to the increased cash accruals relating to the normalization deferral levels that I mentioned before, but also to higher group-wide technology, risk and compliance costs. The division therefore delivered an adjusted pre-tax loss of 55 million US dollars against a backdrop of reduced capital usage and lower client activity across all business lines. I would note that the $174 million release in the provision for credit losses relating to Arcados, as well as real estate gains, partly offset by restructuring, meant that on a reported basis, our pre-tax income was $134 million. Now, just a brief word on capital. Risk-weighted assets and leverage exposure was down by 21% and 18% respectively year on year, primarily due to reductions in prime services. We've also continued to allocate capital away from the investment bank as per our strategy, and we've now reduced capital in the division by $2.5 billion compared to the end of 2020, putting us well on track to deliver our ambition of a more than $3 billion reduction by the end of 2022. Let's just turn to the Swiss bank. Now, as we've already said, the Swiss bank delivered another resilient performance in the first quarter. Net revenues were stable year on year at just over 1 billion Swiss francs, with a 7% increase in recurring commissions and fees, supported by an improved performance in our investment in Swisscard and higher levels of assets under management. And that's offset by lower net interest income and decreased transaction-based revenues. The provision for credit losses of 23 million Swiss francs includes a Russia-related impact of 14 million Swiss francs. Operating expenses were 5% higher at 614 million Swiss francs, reflecting again the normalized level of deferrals at target investments and again the higher group-wide technology, risk and compliance costs. Overall, pre-tax income was 8% lower year on year at 385 million Swiss francs. The division saw 6 billion Swiss francs of net new assets, albeit and entirely in our institutional client business rather than wealth or private banking. Finally, let me just turn to asset management. Net revenues for the division were 10% lower year on year at 359 million Swiss francs, with a 48% increase in investment and partnership income, more than offset by a 52% decline in performance, transaction and placement revenues. That does include a reversal of a gain that we reported a year ago in certain CEDA funds. Now, taken together with the 15% year-on-year increase in operating expenses to 308 million Swiss francs, reflecting the increased cash accruals due to normalized compensation deferral levels, the group-wide investments in risk, technology and compliance, and 15 million Swiss francs of costs relating to the supply chain finance matter, pre-tax income for the quarter was 51 million Swiss francs, 62% lower year-on-year. That reflects the volatile macro environment, as well as reduced activity levels and risk appetite from clients. And I just note that we saw about 0.6 billion Swiss francs of outflows in the quarter, primarily from fixed income and credit, whilst we maintained good momentum in inflows in index solutions. Now, just before I pass to Thomas, one point which I alluded to before. We're planning on hosting an investor deep dive event towards the end of the second quarter, which will give us an opportunity to talk you through the progress and the plans that we have in our risk and compliance functions, our technology function, and the developments in our wealth management division. Now, these parts of the group are all headed by relatively new executive board members, and so this event will also give us the chance to introduce you more formally to David Wildermuth, Rafael Lopez Lorenzo, Joe Hannaford, and Francesco Di Ferrari. And on that note, I'd like to hand back to Thomas just to conclude before we open for Q&A. Thank you.
Thank you, David. Allow me to conclude by reiterating our 2022 priorities that you see on this page. First is to execute with discipline the detailed group strategy and three-year financial plan, which we presented at our Investor Day on the 4th of November. Together with my colleagues on the EXP, we share a clear commitment to implementing the new strategy of strengthening the core, simplifying the organization, and investing for growth. Second, we will continue to improve risk and compliance with an emphasis on risk culture, whilst not losing our client focus and the entrepreneurial spirit that has been the hallmark of Credit Suisse since its foundation more than 165 years ago. Third, we aim to re-establish franchise momentum, grounded in the positive basis for growth in our 4 divisions with a regional overlay and supported by a disciplined approach to costs and investments. With that, let me turn to Kinner to begin the Q&A.
Thank you. We will now begin the question and answer part of the conference. May I please ask everyone to stick to a maximum of 2 questions, please? Operator, let's open the line, please.
Thank you. Anyone who wants to ask a question may press star and 1. If you change your mind and wish to remove yourself from the question queue, please press star and 2. Anyone who has a question may press star and 1 at any time. And the first question comes from the line of Magdalena Skoglova from Morgan Stanley. Please go ahead. Your line is now open.
Thank you very much. Can you actually hear me well?
We can, yes. Magdalena, yes.
Okay, lovely. Lovely. I've got 2 questions. And thank you very much for the slide 7 in the presentation, which I thought was very useful. And really, my first question is about exactly that. Could you give us a sense of the impact from the kind of de-risking measures, but going forward in wealth in particular? Kind of what are the milestones to the business normalization in wealth as you see it? Is it the finalization of the FINMA outstanding investigations? Is it the additional client reviews? Could you give us a sense, kind of what does it take to see the kind of normalization of wealth business kind of going forward? And the second one, net new money. They have been kind of relatively strong in the first quarter. Could you give us your sense of the quality and the quality of the flows in wealth, but also on the institutional Swiss side? Thank you very much.
Yeah, thank you, Magdalena. So first of all, as you can see on page 7, in terms of the wealth management de-risking measures, they touched really on 5 areas: ship financing, exit of sub-Sahara Africa markets, then the Russia-related de-risking, concentration risks, and client risk review. And if you look at some of the lending volumes that we have also shown in David's sections, for example, on global wealth management, the reduction was quite significant in terms of lending volume. So you can see, for example, net loans are down 14% since the first quarter of 21. You can see that on page 23. And what we really have not yet seen is a rebound of that. It's actually quite the opposite. As you can also see on page 23, net loans went down a further 6 billion from the end of the fourth quarter. And this was partially impacted by Russia and partially by deleveraging in Asia. So in terms of the milestone to the wealth management normalization, you could see in our chart, also on page 6, for example, that the Russia and AFG impact was about 130 million. To the adjusted PTI of 212 for wealth management. And then as you go through the second, third, fourth quarter, we clearly expect and would like to drive a reversal from what we've seen over the last 12 months, namely a reduction of lending volumes, but also clearly a more proactive approach, generally with respect to some of the transactional revenues that are related to larger transactions for our ultra-high net worth clients. So step by step over the next few quarters, we expect to move back to a more normalized return on regulatory capital towards the 18% that we have as a target for 2024. This will not be achieved in the next 1 or 2 quarters, but clearly as we move over the next 2 years, we are moving towards that 18%. That's clearly our target under the leadership of Francesco and his team. and we are fully focused on that. Secondly, on your question on NNA, you say it was positive. Yes, it was positive, but it's not nearly there where I would like it to be. It was marginally positive in every region. It was mainly positive in Switzerland and in Asia, but and also in our external asset management business. But I see substantial more opportunities, particularly also, for example, in the Middle East and in other areas. So I've never been a big fan of quarterly NNA because they are volatile by nature, but this will clearly be the midterm target of Francesco and his team, both not only for assets under management, but more the entire client business volume, which was always my preferred metric, which includes also assets under custody and especially lending volumes. And that's where we want to grow the business and where we see midterm substantial growth opportunities.
I think the only point I'd probably add, Magdalene, to Thomas's points, which I agree with entirely, is just obviously on the interest rate sensitivity, because that is clearly most noted within the wealth management division, given where we are in the curves, because clearly the US has moved first, and that will be a benefit we should begin to see in the second half of this year and then into 2023. And I just wanted to just note that basically.
Thank you very much. But Thomas, can I just confirm that your internally driven kind of client de-risking, deleveraging that we have kind of seen in wealth over the last 12 months is broadly done. So what we are going to see, and I know very, very gradually, is more of an underlying business dynamics as we move forward. Would that be fair?
That is fair, yes, absolutely.
Thank you.
Thank you. And we are now taking our next question. And the next question comes from the line from Flora Bocahut from Jefferies. Please ask your question. Your line is now open.
Yes, thank you for taking my question. So the first question I have is regarding the cost guidance that you have provided. You know, you gave us this guidance of adjusted cost of 17 billion Swiss francs for this year. Indeed, you know, if I annualize the adjusted cost you printed for Q1, this is the run rate we are heading to. The only issue is that the adjusted revenues have been running, you know, around 18 billion of annualized run rate the past 2 quarters. I understand, you know, that part of the cost guidance has to do with the variable compensation and the investments that you talked about. I know, you know, the environment has been tough the past 2 quarters. The only issue is it could remain so for the rest of the year. So the question I wanted to ask you is, do you stick to the 17 billion cost guidance no matter what the revenues end up being this year, which means you could be hardly profit-making on an adjusted basis this year with your Core Tier 1 ratio just below the target? And the second question is actually on capital, whether you could just elaborate, please, on any capital impact that you think could come for the rest of the year, you know, whether you expect further increase in up risk RWA, further impact from model changes. So any other element you have in mind as of today's standpoint on capital would be helpful. Thank you.
Okay, thank you very much. Let's take the 2 questions in turn. Look, I think there is limited cost flexibility in 2022 for really 2 primary reasons. Firstly, I think if we look back at 21, our response to Greensill and to the Archegos matters was to reduce both the absolute amount of variable compensation, but also to increase the amount of deferrals. And that's what drove our cost down to just over 16 billion last year. That was the right thing to do in the circumstance, but it's not sustainable for the long term. And it's why I guided when we spoke earlier this year, and indeed back at the Investor Day, that we'd expect to see at about a 1 billion increase in our expenses. Now, that's not to say that I'm giving any particular guidance over the economic value, the total value of awards for 2022. It's much too early in this year to make that kind of statement, and there clearly is flexibility in terms of that. But I think sitting here at the first quarter, I think it's appropriate to be prudent in terms of what I say about that. I think the second reason is if we think about what we're doing in terms of risk compliance and the IT to actually support it, I think clearly those are necessary investments we need to make as we address the issues that caused so much damage in 2021 to our results and everything else. We are obviously executing a substantial strategic cost program. So I've mentioned already the outsourcing of procurement, the 150 million of cash savings that should generate. We're also putting together all of our operating IT, operations and IT functions under Joe. So moving back to the sort of pre-2016 structure. And that should yield very significant savings. But to be clear, majority of that actually flows through in 2023. And ditto, the exit from Prime. We will save money from that, but at the moment, we're still in the rundown of that particular business. So there is, whether we like it or not, a significant degree of short-term inflexibility in the cost base for 2022. And I think we've warned about that before in terms of where we are now. It doesn't mean there's no flexibility, but I think that's why I'm sticking to the guidance of around 17 billion for this year. We're working very hard at this. We're considering what we should prioritize, what we should deprioritize, but there are certain things, particularly around the risk and control investments, that really do have to actually happen. But I think that's all I can really say. At this point, early in the year, there is clearly some flexibility around variable compensation, particularly with a much lower level of deferral. You understand that. The gearing through to cash is therefore higher. I think in terms of capital, I think our medium-term ambition remains the same. We want to have a CET1 ratio of the group of at least 14% before the Basel IV transition in 2024. We've obviously dipped slightly below that this quarter, mainly due to the 600 million increase in litigation provisions, which mathematically just drops you almost exactly by 20 basis points. I think I probably expect the ratio to reign somewhere in the 13.5% to 14% for the next 6 months, depending on the level of cash generation, other issues we actually deal with, and how we actually allocate capital. But I'd expect our CET1 ratio there afterwards to actually improve at and above our 14% medium-term target in terms of that. I think you asked a specific question in terms of methodology. I think I said back in February that we expected about 6 to 7 billion of methodology changes this year. I think that's still the case, but clearly there will be some increase in op risk RWA above and beyond that as we work through the impact of the litigation provisions that we took 2 weeks ago. But I don't have a particular view at this point in terms of that number, and that's something I'd expect to see in the second half of this year, not in the second quarter. So I hope that's some help. On the cost point, we are super focused on moving to a more flexible structure, but as I said, a lot of this comes through in 23 rather than 22.
This is very clear. Thank you, David, and all the best for the future.
Thank you very much.
Thank you. And we will take our next question. And the next question comes from the line of Alistair Ryan from Bank of America. Please ask your question. Your line is now open.
Yeah, thanks very much. Good morning. Just on the trade-off, to draw you a little bit on that, David, if I may, between the CET1 below target and sort of the risk capacity that the group's put into work. You've got a lot of good franchises, which I think you've sort of sketched your not gearing with, the risk that they might normally take at this point. Absolutely understandably in the current circumstances, but just whether you'd be happy running below the capital target for longer to put some more money back to work, or whether the capital target's more of a constraint. You're still a good surplus to requirements, but below your goals. Thank you.
That's a very good question, Alistair. Look, I think the target setting for the 14% is clearly in respect to the inflation we expect to see when we finally get to the B3R transition in a couple of years' time. And we want to make sure that we have sufficient buffer for that, and we don't have a rerun of what we saw with the B3 transition a decade ago. But nonetheless, I think we've set a medium-term ambition of 14%. I've kind of said, it could be in the range of 13.5% to 14% for the next 6 months. I think there is a balance in terms of that, in terms of putting money to work within the wealth management lending business in particular, and we'd obviously like to see that. But I think it is important that we remain prudent in terms of the group CET1 levels that we actually operate at. So, that's the balance that I'm thinking about really in terms of how we actually operate. I think we have taken some tough decisions in the first quarter, particularly around the litigation provisions. But I think those were the right things to say. And if the cost of that is we drop to 13.8, then it is what it is, I guess. But I think it is important to really put a dent into this. As Thomas said, we've actually got through the dismissal of more than 80 cases and settled 12. So I think it's finally the right time to draw a line under this issue.
Thank you, David.
Thank you. And the next question comes from the line of Jeremy Fiji from BNP.